Hello everyone. Today we will start with the new topic, new chapter of higher financial accounting, redemption of preference shares. Very simple and scoring chapter. It comes in option with profit prior to incorporation, which is again very simple and scoring. Now, all of you will be required to write the notes and the accounting entries what we are going to do in this current lecture, and I will inform you. Okay, in the lecture, during the lecture, I'll inform you that you note down this point in the notebook, and all of you must be writing that point in the notebook. So before we take up with what is redemption of preference shares, first we just recollect. You have already studied equity and preference shares in past, I am sure. So what are preference shares? Why do we call them as preference shares? Equity shares are also called ordinary shares. Okay, ordinary. And why preference shares are called preference? Okay, there are two reasons for that. Preference shares are those shares which get priority or preference over equity shares. They get priority number one over equity shares. In which two cases do they get preference or priority? First, payment of dividends. So whatever profit any company earns, first from that profit, company will give all the interest payments. Interest to debenture holders, interest on loan, all the interests will be compulsorily paid as per the legal obligation. After that, company will pay the tax. Then whatever profit remains after paying the tax, that profit is to be distributed amongst the owners of the company. Now there are two owners of the company, equity shareholders and preference shareholders. So from this left out profits, who will get priority number one in amongst equity and preference shareholders? So whenever from the profits dividend is to be given, first priority we give the dividend to preference shareholders as we have committed them. If we have issued 11% preference shares, we'll give them 11% dividend. If we have issued 15% preference shares, we will give them 15% dividend, provided company has earned sufficient profits. And after giving dividend to the preference shareholders, still if the profits are left out, and whatever profits are left out will get distributed amongst equity shareholders. So why the preference shares are called preference shares? Because they get preference, they get priority. Which is the first thing in which they get priority? Payment of dividends. They will get the dividend before equity shareholders. Okay, you're not supposed to write this. The chapter is redemption of preference shares. Whenever you're supposed to write anything, I'll tell you that. In your notebooks, just give the heading redemption of preference shares. Now, where is the second priority they get? Repayment of capital at the time of liquidation. If the company goes into liquidation, winds up the business, then at that time, who will be given first priority to repay the capital or money back? Preference shareholders. Company will, as it is going into liquidation, company will sell its assets. Okay, all the assets will be auctioned and sold off. Whatever money is realized from that, first you'll pay outsiders, creditors of the company. Now after paying outsiders again, when the turn of owners of the company comes, first company will repay the capital and money to preference shareholders, and then whatever is left out, whether more or less, entire remaining money will go to equity shareholders. So again, they get priority in that, preference in that. If the company goes into liquidation, preference shareholders will get the money before equity shareholders. So these are preference shares. Once again, you don't have to write it, but what are preference shares? Those shares which get priority or preference over equity shares in two things. One, payment of dividends, and second, repayment of capital at the time of liquidation. So this is just to brush up with whatever you have already studied in past years. Now we come to this chapter, redemption of preference shares. Give that heading in your notebook. Okay, redemption of preference shares. Very first Redemption of preference shares is covered under which section of Companies Act 2013? Now we are all studying the new Companies Act, which is 2013. Earlier was 1956. Now we are going to study everything as per Companies Act 2013. So in this Companies Act, redemption of preference shares is covered under which provisions? Section 55. Give this heading in your notebooks. All of you are supposed to write this onwards. This point onwards, whatever comes, you are supposed to write it in the notebook. Okay? So give the heading Section 55 of Companies Act 2013. First thing. In India, a company cannot issue irredeemable preference shares. There are two types of preference shares. Actually, there is a big classification of preference shares. On the basis of redemption, there are two types, redeemable and irredeemable. Then there are several others also, convertible, non-convertible, participating, non-participating, cumulative, non-cumulative. But the current chapter what we are studying is redemption of preference shares. So from redemption point of view, there are two types of preference shares, redeemable. Redeemable means repayable and irredeemable means not to be repaid. Now, as per the Indian Companies Act 2013 Section 55, a company cannot, I repeat, a company cannot issue irredeemable preference shares. As per the Indian law, irredeemable preference shares cannot be issued. All of you must be writing this in the notebook. Next. Only redeemable preference shares can be issued, and that too with a maximum redemption period of 20 years. Mention this in a notebook. Okay? That in India, only redeemable preference shares can be issued, and that too repayment period cannot exceed more than 20 years. What is the maximum period within which the company has to repay the money to the preference shareholders? 20 years. However, for infrastructure projects, preference shares can be issued for a period exceeding 20 years also, but not exceeding 30 years, because infrastructure means you require money for pretty long period of time. So here more than 20 years preference shares are also allowed, but even in infrastructure companies, more than 30 years preference shares cannot be issued. These points are important from your MCQ's point of view. So keep this in mind. As per Section 55, irredeemable preference shares cannot be issued. In case of redeemable preference shares, also maximum redemption period is 20 years. And in case of infrastructure projects, the maximum redemption period is 30 years. You all can pause the video and note down this if you have not written so far. I am continuing further. Okay. Now we deal with conditions of Section 55 which are particularly related to redemption. There are 4 important conditions. I repeat, there are 4 important conditions which you all have to remember. And these conditions are not purely theoretical. They are going to come in our practical questions. Each and every condition will have relevance in our practical questions. And in my next live session, I'll be asking you these 4 conditions also. Accounting journal entries are also based on these 4 conditions. If your understanding of these 4 conditions are not clear, you will not understand the journal entries. So give this heading in your notebook, conditions of Section 55 related to redemption. Okay, note it down. Now first condition, fully paid up. All of you have to write this in the notebook. Only fully paid up preference shares can be redeemed. Write only this much. Remaining, if you want, you can write. It is for understanding. I have written over here. You just have to remember this much. The first condition is only fully paid up preference shares can be redeemed. There is a spelling mistake, not presence shares, make it preference shares. Okay. Only fully paid up preference shares can be redeemed. Now, what does it mean? That I have explained over here. If you are clear with the explanation, you need not write this. This is just for understanding. Condition of Section 55 has not explained this. I have explained it. In condition of Section 55, only this one sentence is written. Only fully paid preference shares can be redeemed. But what does that mean? Number 1. If the preference shares are partly paid up, let us say we have 1 lakh preference shares of 100 each, 80 paid up. I repeat, 1 lakh preference shares of 100 each, 80 paid up. Now these are partly paid up preference shares. We cannot redeem them because company has called only 80 rupees from them. They are the owners of the company. Until they pay full amount to the company, you cannot repay the money back to them. So what will the company have to do? If the preference shares are partly paid up, then the uncalled money should be called first. Just now what example I gave you? 1 lakh preference shares of 100 each, 80 paid up. What is uncalled money? 20 rupees. First company will have to call 20 rupees from the preference shareholders, and then only they can be redeemed. So first company has to make the shares fully paid up. After that only the redemption proceeds can be done. Okay. So if we have 1 lakh preference shares of 100 each, 80 paid up, first company will call 20 rupees from the preference shareholders. Once it is received by the company, then only company will repay them full 100 rupees. This is the first meaning of only fully paid up preference shares can be redeemed. Second meaning, if there are calls in arrears, then such, again make it preference not presence, then such preference shares cannot be redeemed. So suppose we have 1 lakh preference shares as I gave the example, but now 100 is fully paid up. Company has called entire 100 rupees. But there is one shareholder holding 1000 shares who has not paid final call of 20 rupees. These are calls in arrears. I repeat, there is one shareholder holding 1000 shares who has not paid final call of 20 rupees. So 1000 into 20,000, 1000 into 20, 20,000 are calls in arrears. Now what will we do for such preference shares? See the explanation. For such preference shares, either preference shareholders must pay calls in arrears, means company will give them the notice, reminder that you pay this 20,000 or else we are going to do the redemption, you will not get the money back. Means 80 rupees also you have to forget, you will not get it back. So maybe then they pay the 20 rupees first to the company and then company can repay 100. So either preference shareholders must pay calls in arrears or the company has to forfeit and reissue such preference shares before they are redeemed. So company has to forfeit such preference shares, reissue it to someone else from whom the company will collect full 100 rupees, and then company can redeem the preference shares to everyone. So you all remember that only fully paid up preference shares can be redeemed. It means number one, if the company has not called entire 100 rupees, they are partly paid up. First company will call the remaining money, then the company will redeem. Number two, if there are any exclusive shareholders who have not paid the money, there are calls in arrears, then either the company will give them the notice to pay the money and they must pay the money, or else company will forfeit those shares and then only those shares can be redeemed. So if we come across such questions in practical questions, then these extra entries will come. Which extra entries? Calling the final call money, preference share final call to preference share capital, then bank account debit to preference share final call for the first situation, or for the second situation, 4 feature entries, what we studied in share capital chapter, those can also come across. So therefore, if fully paid up preference shares you don't find in the question, any of number 1 or 2 journal entries can come. So you have to remember this condition from practical questions point of view. Okay, so you can pause the video and note it down. As such, you have to write only the first sentence, only fully paid up preference share can be redeemed. And if you feel that you cannot remember the meaning of this, then you can write the explanation also in your notebooks. Okay, but only by writing only fully paid up preference shares can be redeemed, you must understand its meaning that partly paid up preference shares company will call the final call money, and for calls in arrears either preference shareholders must pay it or company will forfeit those shares. Now I am taking up with the second condition, condition 2 for redemption of preference shares. Sources of redemption of preference shares. Okay, this you will write in the notebook, sources of redemption of preference shares. Now preference shares can be redeemed out of number 1, profits of the company otherwise available for dividend, means company can repay the preference shares out of its own profits Otherwise available for dividend means only those reserves can be used which are available for dividend, like general reserve, profit and loss account balance, dividend equalization reserve. You cannot use security premium. You cannot use capital reserve. You cannot use sinking fund. These are not available for dividend. Only those profits of the company can be used which are otherwise available for dividend, means dividend of equity shareholders. So such profits can only be used which were available for equity shareholders. From that you can repay the preference shareholders. If any specific reserves are kept for a specific purpose, that profits cannot be used. That profit has to be used for that purpose only. Number 2, out of the proceeds of fresh issue of shares. Now proceeds of fresh issue of shares means if you are repaying the preference shares, then of the same value you either issue equity shares again in public or same preference shares again in public. Now what is the intention behind this clause? Companies Act wants that when you redeem the preference shares, the capital goes down. Okay, the capital goes down. How to maintain the balance of the total capital same? Suppose the total capital of company is 1 crore. You repay 30 lakhs, means the capital will become 70 lakhs. Companies Act 2013 rather wants that capital should remain intact 1 crore only. Because if capital from 1 crore becomes 70 lakhs, then risk of outsiders increase. Debenture holders, creditors of the company, whom we have not yet paid the money, they invested the money in the company understanding that owners have invested 1 crore. Now owners cannot withdraw the money before we repay them. So as the capital, equity and preference goes down, the risk of debentures and creditor holders increases. So Companies Act want to maintain that balance, that 1 crore capital should remain intact as 1 crore only. So these two conditions are kept. First condition, you redeem the preference shares out of the profits of the company which are otherwise available for the dividend. Now how will the capital remain intact 1 crore out of the first condition? I'll explain you in the next third condition. Third condition will ensure that in the first condition capital remains intact. So right now you just remember that company can redeem the preference shares out of the profits of the company which are otherwise available for dividend. How will the profits of the company help in maintaining that 30 lakhs back? Out of 1 crore, 30 lakhs of preference shares are redeemed. How will the first condition help in keeping that 1 crore intact? I'll explain you in the next condition. But in the second condition, it is quite obvious. You redeem the preference shares of 30 lakhs and you issue further 30 lakhs preference or equity shares in the market. So total capital becomes 1 crore. I repeat, preference shares you redeem with 30 lakhs, so capital decreases by 30 lakhs, you repay them the money 30 lakhs. Now against that, you issue either equity or preference shares in the market for 30 lakhs. So total capital again comes to 1 crore. This is the intention of second clause. On one side, preference shares will be redeemed, so capital will go down. On the other side, you will issue equity or preference shares again in the market, so total capital will become intact. So that balance of total capital 1 crore will be maintained. From which second, out of the proceeds of fresh issue of shares. How will this balance be maintained? From the first, profits of the company will understand in the next condition. Okay. So all of you must note down this second condition in the notebook. Sources of redemption of preference shares. Preference shares can be redeemed only out of two sources. One, profits. Second, issue of shares. When you issue the shares, on one side preference share capital goes down, on the other side again equity or preference shares increases, so total capital remains intact. How this remains intact in the first condition, let us see in the next point. You all can pause the video and note it down if you have not done. I am taking up with the next point. Capital redemption reserve account. Now just now I told you that first point, that if you redeem the preference shares out of the profits, how will that capital will be maintained intact? If preference shares are redeemed out of the profits, then an amount equivalent to the nominal value, means face value, of preference shares redeemed must be transferred from the profits otherwise available for dividend to capital redemption reserve account. So if 30 lakhs of preference shares you are redeeming, then 30 lakhs will transfer from profits to which account? Capital redemption reserve account. Now next line is important. This capital redemption reserve can be used only for issue of fully paid bonus shares. We have studied in the chapter of bonus shares also. First priority of utilization of reserves is capital redemption reserve. So what will happen? When you transfer this amount to capital redemption reserve, sooner or later, company can use capital redemption reserve only for issue of fully paid bonus shares. So share capital will come back to 1 crore. Whenever the company issues 30 lakhs of bonus shares, total share capital will increase and come back to 1 crore. So here also, when you redeem the preference shares from the first source, profits of the company, total capital will remain intact 1 crore and risk of outsiders, creditors, debenture holders will not increase. Okay. So what did I explain you? If you redeem the preference shares will result in decrease in capital, but simultaneously you transfer the profits to capital redemption reserve. Capital redemption reserve will be used in issuing bonus shares in future. So either today or in future, share capital will come back to the level of 1 crore in the example what I gave. So second and third conditions are related to each other. Okay, you all see in your notebook, second condition, preference shares can be redeemed out of first source, profits of the company. And if you redeem out of the profits of the company as per this condition, transfer them to capital redemption reserve. Capital redemption reserve will be used in issuing bonus shares. So right now preference shares capital decreased by 30 lakhs, but when you issue the bonus shares, overall share capital will again increase by 30 lakhs and come back to the level of 1 crore. Then we studied second condition, that is proceeds of fresh issue of shares. In that situation, immediately one capital decreases, other capital increases, so total 1 crore of capital level will be maintained. Okay, so what is the purpose of these conditions of Section 55 Companies Act? Companies Act has tried to protect the creditors, debenture holders and other stakeholders of the company. Any event in the company must not result in increase in their risk. Risk has to be borne by owners only. So when will their risk not increase? When total capital remains same. You all can pause the video and note this down if you have not written. I am taking up the next condition. Fourth and last condition. Premium on redemption of preference shares. Preference shares can be redeemed at par or premium. Mind well, when they are issued at premium, that premium is capital profit for the company. Because you are issuing the shares, you are getting the money. But when you redeem the preference shares at premium, that premium is a capital loss for the company and liability. Because we have to repay more amount to the preference shareholders. So very first of all, what is this premium on redemption for preference shares for the company? It's a capital loss as well as liability. Capital loss because we have to pay more amount than what we borrow from them. Liability because it is payable back in future. So premium on redemption for preference shares, which is a capital loss, shall be provided out of profits of the company or security premium account. Okay, when you write this profits of the company, write down in bracket profit and loss account. Okay, premium whatever is payable on the redemption of preference shares, how will you make the provision of the same? Either you'll keep aside from the profits of the company that much amount, or you will utilize security premium account to pay that premium. Right, so all of you must note down this condition also. Fourth and last condition, premium on redemption of preference shares shall be provided out of profits of the company or security premium account. Have a look at all the four conditions once again in your notebook what you have written. Number one, only fully paid preference shares can be redeemed. Number two, sources of redemption, First source, profits of the company otherwise available for dividend. Second source, issue of fresh proceeds or proceeds of fresh issue of equity or preference shares. Third, if we redeem out of the profits of the company, then amount equal to the face value of preference shares redeemed must be transferred from profits to capital redemption reserve, which can be further used in future to give bonus shares. And last condition, if preference shares are redeemed at premium, then premium shall be provided out of profits of the company or security premium account. Very important, all the accounting is based on these four conditions. When we do the accounting, I will ask you to refer to these four conditions again. So you all must have written it in the notebook, otherwise rewind the video and note it down. Because when we do the accounting, I would like that you all refer and read that condition again so that you understand the journal entries. Okay. So if you have not written, pause the video and write it down. I am taking up with the accounting for redemption. Give this heading in your notebooks. Accounting for redemption. Now, coming back to four conditions. First conditions, journal entry, I am not making you write because you already know them. What are the first condition? Only fully paid preference shares can be redeemed. So what if they are partly paid up? We'll pass those two journal entries. Preference share final call account debit to preference share capital will call the money. And then bank account debit to preference share final call. You already have studied these entries in share capital chapter, so I'm not making you write them again. And what if there are calls in areas? We'll call the money. If they pay it, bank account debit to calls in areas. If they don't pay it, we forfeit. Then share capital, preference share capital account debit to share forfeiture to calls in areas. On reissue, bank account debit, share forfeiture to share capital. And on transfer to capital reserve, share forfeiture to capital reserve. So those entries are studied in past chapter. They are going to remain same. I am directly taking up with the entries from second condition onwards. What is the second condition? Check it in your notebooks. There are two sources. Number one, profits of the company. Number two, fresh issue of shares. Now understand this. If you redeem the preference shares from the first source, that is profits of the company, then profits of the company you are using in repaying the preference shares, but hardcore reality is you must have cash also to pay the money. Profits doesn't mean cash. When you transfer any amount from profits to reserve, it is merely a book adjustment, book entry. In the books, profits you are decreasing and reserves you are increasing. It is not necessary that company is having that much of cash balance with itself. So if company utilizes the profits to redeem the preference shares, and if the company does not have necessary cash and bank balance to repay the lakhs of preference shareholders, then company will have to sell its investments or assets to manage the funds of 30 lakhs, 40 lakhs rupees to repay that money. So to manage that funds for sale of assets, what entry we will pass? Bank account debit. Okay, we receive the money. So bank is the receiver, debit the receiver, bank account debit, and assets are sold. So assets goes out, credit what goes out to asset account. Here the difference will be transferred to profit and loss account, means if you sell at a loss, then your entry will become bank account debit, profit and loss account debit to assets account. And if you sell at a profit, the entry will be bank account debit to assets account to profit and loss account. So whatever difference remains in this entry will be transferred to profit and loss account. I repeat, why does the situation of selling the assets arise? Because second condition, company redeems the preference shares out of the first source profits. When you redeem out of the profits of the company may or may not have sufficient bank balance or cash balance to repay to preference shareholders. So what will the company do to manage that funds? Company will sell the assets. So you will have this entry in your practical questions. You will find in our practical questions that to manage the money, company is selling the assets. And we can have combination of two also. Part of the preference shares company can redeem from profits and part from the second source, fresh issue of equity or preference shares. We can have it that way also. Okay. So keep this in mind. Now, second source, if the company redeems the preference shares out of fresh issue of equity or preference shares, then normal entry of issue of shares is to be done. Okay, second source I am talking about now. Company redeems the preference shares out of proceeds of, look at the second conditions, second source. In your notebook, second conditions, second source. If the company redeems the preference shares, if the company redeems the preference shares out of proceeds of fresh issue of shares, then what entry we will pass for fresh issue of shares? Bank account debit to share application account, and share application account debit to share capital account to security premium account if the fresh issue of shares is made at premium. If at par, then simply share application to share capital. And in this situation, you don't have to manage the money because you're getting the money here. Here this 30 lakhs we'll get from the public by issuing the shares, and same 30 lakhs we'll use in repaying to preference shareholders. When does that situation of sale of assets arise? When we use the first source. In the second source, we get the money itself by issuing the shares in the public, and the condition of total capital intact is automatically maintained. Okay, so from the second condition we get these two journal entries. Which are the two sources of redemption of preference shares? Profits. Generally, if you redeem out of profits, the company will come across the situation to sell the assets, for which this bank account debit to assets entry will be passed. And second source, if company redeems the preference shares out of proceeds of fresh issue of shares, then the entry will be bank account debit to share application account debit to share capital to security premium. If you have not written these entries, pause the video and write it down. I am going with the third entry. Now third entry will be for redemption of preference shares. Preference share capital as a credit balance. To close it, we reverse and debit it. Premium on redemption is a capital loss for the company. I told you we have to pay more money. So by the rule, debit all expenses and losses. Premium on redemption account debit. And the money is payable to preference shareholders. Credit the payable. So to preference shareholders account. Okay, note it down in your notebook. For redemption of preference shares, preference share capital account debit. Why? Share capital as a credit balance. Now we are repaying the money. So to close it, we reverse and debit it. Premium on redemption account debit. Why? It is a capital loss for the company. Debit all expenses and losses. And to preference shareholders account credit. Why? Amount is payable to preference shareholders. Credit the payable. Now, don't look at the third condition. Directly look at the fourth condition for fourth entry. What is the fourth condition I made you write? If preference shares are redeemed at premium, then premium shall be provided out of profits of the company, that is P&L account, profit and loss account, I made you write in the bracket, or security premium account. So fourth entry, for writing of premium on redemption. See, just now in third entry, premium on redemption account we debited. If you write it off, what will you do to close that premium on redemption account? You'll reverse and credit. I repeat, in the third entry, premium on redemption account is debited. To write off that premium, you'll reverse and credit to close that account. So see in the fourth entry, can you see credited to premium on redemption account? Now, which are fourth condition? Which are the two sources from which premium can be written off? Premium can be provided from which two sources? Profits of the company, so profit and loss account debit. Security premium, so security premium account debit. First priority, we will use security premium. If security premium is insufficient, we will use profits of the company. So that's why in this journal entry, security premium account debit I have written first. In bracket write first priority. And profit and loss account debit in bracket write second priority. Mention this. Okay. So what will be the entry for writing of premium on redemption? Premium on redemption is debited in the third entry being a loss. To write it off, to close it, we will reverse and credit in the fourth entry. And this premium can be provided from which two sources as per the fourth condition? Profits of the company, that is profit and loss account, and security premium. But first priority, security premium account debit. Second priority, profit and loss account debit to premium on redemption. So from the fourth condition, we get fourth journal entry. Okay. Now, fifth entry comes from the third condition. What is the third condition we studied? If we redeem the preference shares out of the profits of the company, then that profits must be transferred to capital redemption reserve. that capital redemption reserve will be used in future to issue bonus shares. So what entry will we pass to transfer the profits to capital redemption reserve? Write down in your notebooks. For transfer of profit to capital redemption reserve, if we are using dividend equalization reserve, then dividend equalization reserve account debit. What did we study? Which profits of the company can be used? Which are otherwise available for distribution as dividend. So which are such profits which are available for dividend? Dividend equalization reserve account debit, general reserve account debit, profit and loss account debit. All these three are available for dividend. And where do you transfer them? To capital redemption reserve account. Now, I am not mentioning the entry of issue of bonus shares again, that we have studied in unit 1. If capital redemption reserve is used further for issue of bonus shares in future, then you already know the entries. Capital redemption reserve account debit to bonus to shareholders, bonus to shareholders account debit to share capital. I repeat, issue of bonus shares entry I am not discussing. If it is given in the question that bonus shares are also issued instantly, then those entries what we studied in unit 1, we have already studied them, they are going to remain same. We are studying here only new set of entries. Those entries which you have already studied in unit 1 are going to remain same. Now last entry, for payment to preference shareholders. Only redemption is done, but money is not paid. Now for the final payment, preference shareholders are the receiver, debit the receiver. So preference shareholders account debit, and if you pay the money through bank, then bank is the giver, credit the giver to bank account. So all these 6 entries you all must note down in the notebook, revise them repeatedly well. In the next lecture, we will start with the practical questions which will have these 6 entries. So complete lecture, revise it well, which are the 4 conditions of redemption, and from those 4 conditions, which 6 journal entries are derived. Revise them very well before you watch the next lecture. Ideally, I'll suggest after this lecture, without seeing, write all the 4 conditions again in your notebook and all the 6 journal entries again in your notebook for practice, so that you are confident with the 4 conditions and 6 journal entries. That will be all for this lecture. We'll meet in the next lecture with the practical questions. Bye everyone. Take care. See you in the next lecture.